my name's James Nicholson and welcome to my YouTube channel. In this video, I want to talk about the pros and cons of a fixed rate mortgage against a tracker mortgage. Now, we've done these types of videos before, but now it's a little bit more interesting because you've got brokers saying the Bank of England is going to increase rates. You've got economists saying that the economy is going to go into a recession. And things aren't looking great. And if that happens, then the Bank of England would be forced to cut rates. So it's a difficult decision to look at. And that's why I want to give you the pros and cons so you can make that decision for yourself. Now, if you're new around here and you haven't done already, do make sure you subscribe to the channel over there and hit that bell notification. We're on the way to 40,000 subscribers now. You can see how close we are around here. So do that. And while you're here, let's get some more views on this video by smashing like, tickling like, doing something to that like button, and smash that share button, WhatsApp, Facebook, or Google this. No, that makes sense, does it? Hey, my name's James Nicholson and welcome to my YouTube channel. In this video, I want to talk about the pros and cons of a fixed rate mortgage against a tracker mortgage. Right now, we're in really uncertain times and things could go two ways. We did a video the other day where 69% of brokers are saying they feel the Bank of England are going to increase their base rate. But we've also got economists saying the economy isn't looking great. It's likely that the UK will go into a recession. It's also possible that America could go into a recession. And if that happens, the Federal Reserve will cut rates. The Bank of England like to have their rate fairly close to the Federal Reserve as well. So if the UK goes into recession or America, this could impact rates in a downward momentum. So there's lots to consider here. So before we jump into this, as always, if you haven't done already, do subscribe to the channel over there and hit that bell notification. We've got new content on property investing, property news, every single day, so make sure you subscribe for that and smash the like button, tickle the like button, do something to that like button. That helps with the YouTube algorithm and helps the channel grow. And share the video, WhatsApp it, email it, Facebook message it to someone and let more people know about this stuff, because I'm sure you know someone right now that's considering whether they should fix their mortgage or go for a tracker. So let's have a look. Well, there's two types really of mortgages. You've got the fixed type. And so a fixed mortgage is the most common, and that's what most people would normally go for. And so you can fix for 2 years, for 3 years, 5 years, or some people even fix for as long as 10 years. Now, mortgage lenders right now are trying to push people onto a 5-year deal to get you locked up for the longer. That indicates they believe that interest rates are likely to go down. But there's no certainty on that. Things could change any moment now. And there is a lot of uncertainty. You've got wars in the world. You've got tariffs from Donald Trump. You've got a really, really bad budget that we had in the autumn from the Labour Party. And all of these things are giving uncertainty. So what are the benefits of a fixed mortgage to get you through that? Well, you can fix the cost for 2 years, 3 years, 5 years, or 10-year fixed, as we said. Now, at the moment, the 5-year deals are offering the better rates, but in normal times, 2-year deals are pretty good because they want you to refinance fairly often, so they get new fees and all of that kind of stuff. So that's important. Now, what you've also got here is a fixed monthly payment for the length of your term. So that's 2, 3, 5, or 10 years. And so that gives you certainty. And so if you are using a lot of your monthly payment, your take-home pay towards your mortgage payment, it would be good to know that it's not going to suddenly increase. You don't have the luxury of taking any gambles in that situation. But a lot of people just like to know what their bills are going to be. And over the last few years, we haven't had that certainty. Look at your energy bills. They've been really high. They've dropped. They've gone high again. That isn't fun for a lot of people. You've got that with your cost of goods in the supermarket as well that have risen considerably. So a fixed price and a fixed payment every single month just gives you that certainty on at least this one bill, which is probably the biggest bill that you have in the house. So that's good. What's a con? Well, when you fix this deal after the term, so let's say you fix for 2 years, then afterwards you're going to go on the standard variable rate with that bank, and that can be expensive. Now, you don't have to go on that. You've got to make sure you get a new deal in place. But if you had any problems getting a new deal, maybe your credit rating got hit hard, maybe you lost your job, you're going to go on to this standard variable rate at that time, and that can be 5% above the Bank of England base rate. So there are some places at the moment where it's 9.5% the interest rate, which is very, very high. Imagine if you owe 500 grand. That's going to be a lot every single year. So that's a downside on that. Also, you miss out on rate cuts. So if the Bank of England do cut rates and that lender then does a better deal, you're not going to get that deal because you're fixed on the deal that you've got, which has a pro. But as we said, if you feel that interest rates are going to drop down, maybe we're going to have a recession, maybe something else might happen, you're not going to get the benefits of that. So that's fixed. What about tracker deals? Because people are looking at these now. Now, we have been running this channel for nearly 3 years now. When we started this, interest rates were ultra low, and they started to go up pretty much as we launched the channel. Now, as that happened, I remember a lot of people commenting saying, I'm going to go onto a tracker rate. Now, those that did that, it probably didn't work out so great for them. They probably got off that rate at some point, but as the rates went up, so did their payments each and every month. So that wasn't great in that scenario. But now interest rates have likely peaked. Now they could go up. Brokers are saying there's a possibility of an increase with the Bank of England, but it's not going to be loads. We're at 4.5% now. We're not going to go to 8%, for example. But we could go back up to 5% at some point. So there is that little bit of volatility there. Now, a lot of tracker rates are 0.75% above the base rate, so the Bank of England base rate. So if you're on a tracker right now that has that kind of deal, that means the base rate with the Bank of England is 4.5%. 0.75 on top of that is 5.25. That's what you would pay at the moment. Now, there's a lot of fixed deals that are also around the 5% level. But if the Bank of England now does cuts with their rates, you're going to go down quite quickly, aren't you? So if they go down to 3.75%, you're going to get to 4.5% very quickly, while the fixed people are stuck at their higher rates. Or if they drop to 2% at some point, maybe we went in a bad recession, in that scenario, your rate's going to go to 2.75%. So that is very, very good. Another thing is, with most tracker rates, you have to check this. You need to check with your broker when you're signing up for any deal, but with most tracker rates, you can leave the deal. And so let's just say, for argument's sake, rates tumble down to 2% again. And now you think, well, I'm not going to get much more benefit from this tracker rate right now, and rates could go up again, so I want to move on to a fixed deal. You can normally leave your tracker rate with a few months' notice and get that fixed deal in that scenario, putting you in that strong position. Now, with all of this, you've got to really make sure you speak to a broker to find out your affordability. There are massive pros with both, and there are massive cons with both. With the tracker, the people that pick that, you would be in the camp that you feel interest rates are likely to drop. A lot of economists are saying that. If you like the certainty, a fixed rate is definitely the best option for you. What would you do? Or what are you doing in this current market? Do comment below and let me know. Do smash like, subscribe, check out all the other content as well on the channel, including this video right here.